Be Wealthy and Smart, episode 1036.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 3 things that will get more expensive after the Fed's historic rate hike. Now, it's no secret that the Fed has talked about wanting to hike interest rates about 11 times between this year and 2023. Will that happen? Well, I don't think so. I think we are going to get a relief in inflation. And in fact, the rally we're seeing today is a result of early signs of inflation just starting to get a little bit better. And that's what you want to see first. Before you get the bigger result that inflation has actually peaked, you'll start to see the change of inflation, the rate of it, start to soften a little bit. And there are little signs here and there. You can call them green shoots or whatever you want to call them. But there are little signs that inflation is looking a little bit better. And that's good to see. That will help the Fed not have to make as many rate hikes, perhaps, which will help corporate profits, so that's all good news. But I wanted to bring to you this article from Mike Winters on CNBC because I thought he brought up some good points, and they were also personal points that affect your personal finance. So let's talk about how this inflation is impacting your finances. He says a few of your regular everyday payments are about to get more expensive. The Federal Reserve increased the cost of borrowing by raising its Fed funds rate by 0.5% on Wednesday, its largest hike since 2000. The rate is now in a range of 75 basis points to 1%, and the central bank projecting a total of about 6 additional hikes by the end of the year. It is expected to rise to 3% to 3.25% by year end. So I want to pause here and say what's interesting about that is with the Fed's 0.5% interest rate increase this week, we've already seen mortgage rates up 90 basis points or just less than 1% from a month ago. Currently, the 30-year mortgage rate is at 5.9%. which is still historically very inexpensive money. Anything under 8% is considered inexpensive money, in my experience. But it is impacting people because they can't buy as much home, their payments don't go as far, what they can offer in terms of a price is impacted by the amount of the payments. So all of that gets intertwined and will help to slow down the housing market a little bit. I don't think hugely. I think the demand is still there. People may have to buy a less expensive home, or they may want to save more and put down a bigger down payment, or try and pay all cash if they can. But with housing prices so expensive, that's just not very reasonable, especially for younger people. Let's see what else the article says. He says, by raising the Fed funds rate, the Fed is making it more expensive to borrow money. This is meant to reduce inflation. The cost of goods in the U.S. has soared to 8.5% year over year, according to the Labor Bureau's most recent Consumer Price Index data. Typically, the central bank's yearly inflation target rate is about 2%. So he goes on to say, with the 0.5% interest rate hike, you can expect higher rates for credit cards, mortgages, and other loans. Within the credit card category, your credit card's interest rate will likely increase slightly within a couple of billing cycles. The size of that increase can vary based on your credit score and credit card provider. A 1% interest rate increase will likely only add a few dollars to your monthly interest payments on a few $1,000s of outstanding debt. Current average interest rates are close to 16%, but could be as high as 18.5% by the end of the year, according to Ted Rossman, a senior industry analyst at creditcards.com. The second thing that could get more expensive after the historic rate hike is your mortgage. And the article says mortgage interest rates are calculated based on multiple factors like inflation and the housing supply, but they're also affected indirectly by the Fed funds rate, which influences how much banks pay to borrow money. When that rate increases, the interest on adjustable rate mortgages tends to follow. And I've already talked about the 30-year mortgage rate, but according to Gary McBride, an analyst from Bankrate, he said even 15-year fixed rates will climb to around 4.75% to 5%. 30-year mortgages are already up by almost 2% in the last year, which works out to hundreds of dollars in added monthly costs. And then thirdly, other loans could also be impacted because any loan tied to the prime rate, known as adjustable rate loans, will have a slight increase in interest rates. The size of that increase will vary depending on your credit score and the terms of your loan. It could affect your financing for a new car, personal loans, or home equity lines of credit. Variable rate student loans also tend to rise with the Fed funds rate, although technically they aren't directly linked. If you currently have a fixed rate loan, your payments won't change. If you have an adjustable rate loan, you should take some time to look at its terms, said Jacob Channel, a senior economic analyst at LendingTree. He says the last thing you want to think is, oh, I have a few months before my rate goes up, and then realize that the rate hike will kick in much sooner. End of article. Well, that's the thing about variable interest rates, is that the rates can continue to go up, which will impact your payments directly, which is why I only recommend fixed rate mortgages. In this rising interest rate environment, the risk is too great that interest rates will continue to rise and will increase your payments. You definitely don't want that. You want to know what your payment is every month. So don't get lured in by the low variable rates to try to qualify for a house thinking you can refinance later. I don't think that's realistic, and I would really discourage anyone who's thinking that way. I think it's good to be on the safe side and get the fixed rate loan, purchase the house you can afford, keep your payments steady, and that way you know what your payment's going to be every month. So regardless of inflation going up around us, your payment will stay the same. With the Fed feeling like it's so behind the eight ball with inflation running at 8.5%, and we know truly it's closer to 15%, and interest rates at less than 1%, well, you can see the problem that the Fed has, that they have not kept interest rates up with the inflation rate. So as they try to close that gap, they're in a race to raise interest rates. But now, because we're starting to see a little bit slower growth in inflation and possibly getting close to a peak of inflation here somewhere in the next few months perhaps, that will ease off the Fed's pressure to be increasing interest rates so much and in such short a period of time. I do see inflation working its way through in the next few months and easing up a bit. So the good news of not having to raise interest rates as much will definitely be a benefit to the stock market, and the stock market will like that. I also think that will enable money to move back into the high growth tech stocks, and we will see a resumption of the former winners, like the FANG stocks, to regain their lead again. This trend out of growth stocks into value stocks like Clorox will turn around and go back into high growth tech stocks, I believe. So hang in there. Things are going to get better. We could have another week of some chop as we're finding a bottom here in the stock market, but I do have a rip-roaring bull market coming very soon. If you'd like to get my weekly updates, sign up for my newsletter at lindapjones.com. And while you're there, you'll find all of my podcasts on my podcast page with a search box so you can look up any topic you want to know more about. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.